Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. Okay, so welcome back. In this video, we're actually going to be talking about naked short calls, right? Now, this is so normally in the previous videos, we talked about buying a call, right? When you buy a call, you want the stock to move higher. Well, in this case, we're taking the other side of that trade. So we're actually going to sell the call. Okay, and so if we sell the call and we're taking the other side of the trade, we actually want the stock to go lower. So the market opinion is neutral to bearish. Okay, and you will always receive a credit whenever you're doing these short calls. Now, refers to selling a call without owning the underlying stock, which will give you unlimited risk. That's because there is no limit to how high a stock can go. You will want to sell a call if you think the stock will go sideways to lower. So what you would do is in the platform, you'd want to sell one XYZ October 20 call, and you'll receive a $1 credit. Okay, now your max loss is unlimited because price could go as high as it wants, right? Your max profit would be $1. The most you can make on this trade is the credit you receive, because remember, you want this to actually close out of the money, right? So break even is if the stock closes at $21 or higher. So let's take a look. We'll go back to our Viacom, right? And in this case, let's say we sell with 28 days left, right? The 42 calls, right? So instead of buying the calls, we would be selling them. We would collect $2.61, right? Well, if the price goes lower, then those calls are going to get cheaper and eventually worthless. And that is our ultimate goal. We want the price to go lower and these options to essentially expire worthless. And that's what's going on in this situation. So here's an example. Stock XYZ is trading at $20, and you think in the next month the stock will trade sideways or below $20. So you could sell a $20 call and collect $1 of premium. And as long as the stock stays below the $20 by expiration, you will collect the full $1 of premium and the option will expire worthless. Your break even on this trade would be $21 and will start to lose money if the stock trades above $21. So in this example, if the stock closed in October, okay, at expiration at $22, we'll say, you would lose only $1, because even though you sold the 20 calls, remember you collected $1, so that gives you a $1 buffer, and then it went to 22, so you then lose $1, another $1, but you collected $1, so net you lose $1. So that is selling a naked short call. And we'll see you on the next video.